Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Friday, April the 25th, 2025, Anzac Day for those who follow that. Okay, so I just want to check on a couple of things, guys. Some interesting comments for yesterday. This is kind of bigger picture stuff, and just trying to sort of figure out what's going on with the Fed and potentially where we might be on interest rates, the path of sort of monetary policy. And so I just want to pull back a little bit because it's Friday morning here. So essentially, what has been happening is that Powell has, over his last two or three speeches, said that there are the mandate for the Fed is to keep interest rates, price stability, stable, so sort of inflation stable, but also to have full employment. And he said that those two mandates, those two objectives, are potentially coming a little bit more in tension. And so the question is, as long as inflation remains sticky. And remember that America, especially lower and middle class Americans, have been through a huge sort of inflation sort of trauma and shock over the last year or two. And there's a lot of political pressure from Trump to keep inflation down in theory. So Powell does not want inflation to go up. So on one hand, he has to keep inflation sort of under control and therefore cannot cut interest rates too dramatically. On the other hand, of course, he wants to keep the employment situation strong and the labor market strong. And so therefore, if he keeps interest rates high for too long, yes, he will continue to sort of combat inflation, but he's going to potentially cause unemployment and pain to, sort of the labor market. So Powell's approach at this point seems to be to say, okay, let's wait until the May meeting, definitely, maybe June, but let's just wait and let's see if those two, just see how those two sort of different objectives play out. But what was quite interesting, I think, yesterday, and from not only from Waller of the Fed, but also Hammack, who's non-voting, but still Hammack's another member of the Fed, is a slightly different perspective, which indicates to me that there could be sort of some kind of sort of internal tension at the Fed going through. And essentially what Waller was saying in his speech was that he seemed to be saying that he would be prepared to tolerate a little bit of inflation and he would prefer to keep the employment situation strong. He would prefer to keep the labor market, very sort of strong. And I just did a couple of screenshots here from some of his comments. So he said, Waller on rate cuts, if I saw enough movement in the unemployment rate to think that things were going bad, with growth tanking going down, then I'd be ready to go. So ready to cut interest rates. So he's basically saying that the most important thing he's looking at is the labor market here. And then he says here, Waller, I'm willing to look through, so to ignore whatever price increases there are. So this is quite important because he's essentially saying that if inflation may be sticky and if the tariffs continue to be sort of active, he's basically saying that that's a one-off price increase and that he's got to look through that and ignore that, which is quite a different sort of message which we're getting from Powell. And he said here, if I see a significant drop in the labor market, I would expect more rate cuts and sooner. Okay. Then he said, to be sure, it's going to take some courage to stare down, so to basically to face these tariff increases and prices. So essentially what he's saying here, which I thought was actually pretty interesting, was that he's saying, listen, there could even be sort of pressure, political pressure, a lot of ridicule. He's saying it's going to take some courage to stare down these tariff increases and prices. And so essentially he's basically saying that, even if, there seems to be sort of price increases and maybe even very sticky inflation, he personally would be sort of more willing to sort of cut more, as he says, more and sooner. Now, when could soon be? He said, I think he said, he has a date here. Yeah, he said, how soon could you see the data that forces the Fed to change policy? And he says, I don't think you're going to see enough happening in real data in the next couple of months until you get past July. So it seems, so this is an interesting forward path. He seems to be saying that he expects it's going to take 2 or 3 months for the real economy the data in the real economy to start weakening. And then he personally would sort of look through any sort of temporary price increases or what he regards as temporary price increases and would cut more aggressively and sooner. So maybe in like June or July, August and quite quickly. So the market quite liked that. And it's just kind of interesting to look at a couple of things. So if we look at a little bit of the data we got yesterday, just to put all of this in in context, we can see that, and again, I'll go on the daily shot, which has a lot of nice data. You can see there's a couple of interesting things. So you look at the durable goods here for March. Now, this is, before the tariff announcement by Trump, but you can see the durable goods here. They actually surged quite a lot. Okay, not that was on the transportation equipment, not so much on the excluding transportation was pretty flat. But the point is that a lot of the big ticket items, it seems as though there was quite a lot of front running. So does that indicate that as we go into sort of April and May data, people will have pulled back, and that actually the real economic data will start to deteriorate a little bit? It's possible. We'll see. That's what a lot of people are expecting. Now, what about the labor market? It seems that the labor market, yesterday we got initial jobless claims. And if you look here, initial jobless claims, again, yesterday they were very low, 220,000 or something like that, as expected in the blue here. And you can see for this time of the year, that's actually pretty good. We're certainly not getting in elevated levels. We're absolutely in historical norms. This is a strong labor market. So it's just interesting to keep an eye on all of this stuff, really to understand, is the real economy weakening? Have people kind of front run the potential tariffs and bought a lot of stuff and they're going to pull back? And will that lead to sort of job cuts and a real acceleration in the labor market and the real economy actually deteriorating in, let's say, as we go into May and June. And at least for Waller, at least part of the Fed, maybe not Powell, but at least part of the Fed is saying, if that's the case, we've got to put the price pressures and the inflation and the price increases to one side because we need to focus on the real economy and stimulating that. Okay, so from a market perspective, what was interesting there, if we sort of have a look, we can just go and have a look and just see a little bit of market reaction. The front end of the curve quite enjoyed that sort of dovishness. And if we just see what's being priced in at the moment for the Fed, we can see, not a huge amount, but let's say, for example, if you go in the next meeting, May, coming up in a couple of weeks, we've only got 2 basis points of cuts. So essentially the market's not pricing in anything. But then what starts to get interesting is June. So if you look at June here, we've got 16 basis points, which is essentially a 65% chance of a cut. So the market pushed up the possibility of cuts on the back of Waller's comments yesterday. And then if you just look at the sort of the end of the year, going out to December, which I like to look, we're at about 3.5 cuts at this point. So, some people are saying that if the economy does deteriorate, relatively soon and rapidly, the Fed is not going to do 25. So they might even start off with a couple of shock, maybe 50 basis points cuts. So the point is that 3.5 is equivalent to 85 basis points of cuts. And some people are saying that, there could be, even up to like 100 basis points or 125 basis points by the end of the year, certainly going into 2026. And just interesting, I saw that there was a big trade put on by an institution yesterday based on the September 2026 contract, essentially arguing for a lot more cuts, like another 2 or 3 cuts. So it's a long SOFR call spread on the September 26th. So definitely some institutional players are thinking that the economy might actually slow down a little bit more than is currently priced into the curve here. And if you just want to look at how that kind of thing plays out, let's say on the SOFRs and whatnot, we can see here on a tick chart, so very quick, short dated in intraday, we can see Waller's comments yesterday, see around about sort of in the morning here, you see that over the course of the day, this is the number of basis points on the right-hand side here, which is priced in. So you see that at the beginning of the day, it was about 83 basis points, but by the end of the day, it got down to about 87 basis points. So you see how it came down here. So that's indicating another sort of 3, 4, 5 basis points of dovishness being priced into the market. And you can see that, we went up a little bit overnight, but subsequently this morning, we've returned to those levels. So the market at this point is doing some risk management and saying that it doesn't exactly know what's happening with Trump and the tariffs and China and everything. I'm just going to grab some tea. Excuse me. But definitely there's a little bit of a tail risk being bought in. Now, in terms of what happened overnight, we had pretty strong earnings from Google, less so than from Intel, but Google had some, pretty strong in the data centers and the cloud computing. Advertising revenue was strong. So Google was a beat. Intel, on the other hand, was a little bit sort of soft in terms of their forward guidance. So, slightly contradictory sort of messages there, but nonetheless, Nasdaq had a little bit of strength overnight just on the Google, especially kind of earnings. In terms of other stuff overnight from China, it's very contradictory because Trump is saying that, for example, someone like Bessent, the Treasury Secretary, is saying, he had a great meeting with South Korea. There could be a deal as soon as next week. Trump was saying, things are going great with China. But on the other hand, as I mentioned yesterday, China has officially said that no, there's no official sort of tariff conversations going on. Trump this morning just issued an interview which came out with Time magazine, I think, essentially saying that he had spoken at some point in the past with President Xi Jinping of China. So it's a lot of contradictory signals. Maybe there's sort of trade talks going on behind the scenes. China seems to be saying, no, we need more respect. There's no official talks going on. So contradictory signals. Trump, in the same interview which was released just this morning, he said that if he could have within a year's time a 50% tariff level, a level of 50% tariffs, he would think that is a victory. So it's kind of interesting that for Trump, I think this is what the market has to understand, that for sure he doesn't expect, or the market doesn't expect that 125% tariffs will remain on China. But it does seem, at least if you take him at what he's saying, and this is from this morning, that Trump still believes that some reasonably high sort of form of tariffs is his base case and his desired outcome. So whether that's 10, 20, or 30% on varying countries, the reality is that there could be a relief rally if such deals go through, but we're still a long way from pre-Trump at much more elevated levels of tariffs, which ultimately should cause a global slowdown, or could cause a global slowdown, and a sort of a trade conflicts and whatnot, which is not going to be good for the equity market. So just kind of interesting to keep an eye on looking at all of that stuff. In terms of just some of the markets, let's have a quick, where are we? Let's have a look. Equities up a little bit, but giving it back. So you can see that equities had a bit of a positive day here. This is the S&P 500. Had a positive day, but as you guys can see, giving it back, it looks as though this level, as I was talking about yesterday, these levels up at about 55.50 are difficult. This is the gap. This is when Trump on April the 2nd announced all the tariffs, and you can see he'd gapped down at the futures open overnight between 5 and 6 p.m. So this level, the gap level here, it does seem to be pretty critical. What could happen? I mean, I don't know if there's sort of more positive earnings and the market wants to push up. I think just looking maybe at the SPX, just kind of a clean chart here. This is the cash index here. That anything if you get up to sort of these levels here, up in the 5,600, if it can breach this gap here, maybe go to 5,500 and then sort of push its way up into this gap here. I think anything above this gap around about 5,600 on the SPX, or going back to the ES, anything, around these levels here, 5,650, whatever, 5,630, something like that would be very attractive risk reward. We also have, in theory, a little bit of a downtrend kind of overhead resistance here. So it's going to be an interesting moment here. It's Friday today. Maybe the market wants to take off a little bit of a risk going into the weekend in case there are any sort of headlines. On the other hand, there has been a little bit of positivity. It seems as though, as I just mentioned, that there may be behind the scenes some talk with sort of Japan and South Korea, especially maybe with India. There's talk of a deal happening with India. China's a bit more complex. Although, on the other hand, yesterday, we had some of the European sort of leaders and ECB officials saying that there were some positive sounding talks in Washington, and a deal could be done. So a little bit of positivity, we shall see. So just in terms of some other markets, interesting to see what's going on. Like, let's say, for example, look at oil, and you look at oil here, which actually, and this sort of potentially a bear flag, is sort of falling a little bit, just finding it difficult to push higher. So oil, for one, is not exactly signaling very strong kind of belief that global trade will be going up. And if we just look at some of the metrics for oil, kind of interesting here. What I've done is just to bring up some of the curves and everything, just to try and get a bit of a set. Well, if I could, sorry guys, there's a lot of stuff on my screen which you can't see, which is proving tricky. This is the futures curve for WTI, and what you can see here is that it's still quite nicely in backwardation. So still buyers are still willing to pay a premium for prompt deliveries here. So that is a positive. I mean, if we look at it, let's say from a day ago, let's have a look, and let's say a week ago as well, just to have a little bit of a context here to sort of zoom in a little bit. What you can see is that the shape of the curve, this is today in the white, this is yesterday in the blue, and a week ago it's this kind of orangey color, burnt orange. And what you can see here is that the shape of the curve is still positive, but obviously the outright price has come down significantly. So it's a little bit contradictory that this still looks as though it's physically tight, but overall, definitely what we're seeing is, as you go out like a few months into the future here, each dot represents one future month of contracts. The price is flattening out and going down. Now, what about the time spreads? What's interesting here, this is CL1 to CL2, so the first and the second month. And what you can see is that they've been fairly, so this is the spread down here below in this lower panel. They've been fairly sort of flat, but we're starting to see, is that just a little bit of, coming down a little bit? We were up to about 70, 75 cents. We're now, as we speak, here in the morning, about 7.50, down to about 64 cents. So it looks as though the CL1, CL2 contract is starting to soften a little bit. And you see here a little bit more just in the pricing here. If we then, though, look at CL1 to CL6, so this is 6 months out compared to the front contract here, you can see that definitely that is a lot weaker. So what we're seeing is, if you push it out to CL1 to CL6, that definitely over the last 24 hours, we're starting to see the time spread starting to weaken, which is a negative sign. So I just wonder if, and obviously the outright price of both contracts is falling, so CL1 and CL6. So CL6 is this one here, and CL1 is the white one. You can see that the prompt spread is starting to fall. So contradictory signals, but it does look as though that price action is weakening, and that's could be a function of the stronger US dollar, because we have had on the risk on, just again looking at a couple of charts, if we look at like going back to the oil here, so could oil just sort of push down here? We shall see. But if we look back and just look at some of the positivity in the markets, we can see the US dollar having not a huge bounce, but a little bit of a bounce. Can we call that? I mean, even as I've been speaking here in the last kind of 20 minutes or so, it's sort of coming off a little bit. Not a huge amount of energy there. Has that been supporting that sort of little dollar rally? Was that sort of a negative for oil? Maybe if we look at some of the sort of precious metals, we can see that gold, had a little bit of a pop yesterday, but is giving it back a little bit. Now, is that because the US dollar was a little sort of strong over the last 20, comparatively strong? Possibly. We're seeing also in silver that's giving it back a little bit, and we're seeing that copper came off overnight as well a little bit. Now, copper is an interesting one. I just want to show you guys also just a couple of things on gold and silver here. Sorry, gold and copper. Just keep in mind for gold, just got a couple of kind of interesting things here. Just looking at the ET flow, the flows in and central bank buying. I've got here, if I go to commodities, yeah. So just kind of interesting here just to see over the last few years, just who's actually buying gold. And we know it's been a huge amount, but look here at the central bank. So this is, again, you see this is every quarter going back to 2017. And you can see here in the red, look at how much of the gold buying is central banks here. A lot of the buying also is coming from the Asian market. So you see bars and coins is actually quite a lot. I was reading overnight, and then this morning, huge demand, retail demand in China, like literally huge demand. And you can see here for some of the Chinese ETFs, these are more like towards the retail market in China. You can see here, Huaan, Ifu, Bosera, Guotai, Ifan, these are all sort of Chinese ETFs here. Absolutely incredible. You look at April, the inflow here of retail sort of yuan going into gold. And that's you see it in February. And it's basically, over the last year, but especially in the last month or two, absolutely huge amount of Chinese retail interest in gold. So as long as they continue to buy, and as long as the central banks continue to buy, gold probably is sort of is a buy on dip situation. The question is trying to figure out what is a nice dip level. In terms of copper as well, we saw that copper's had a pretty strong run up, but what is interesting, we just got some numbers overnight of just the warehouse stock. So you know that we have this the warehouses in New York, in London, Metals Exchange, and in Shanghai. They're the three big ones. And what you can see here is that, especially in Shanghai and the LME, the London Metals Exchange, you see here the inventory, so the amount of copper has actually been going down. So that's quite interesting. That's ordinarily that would be taken as a sort of a bullish indicator because, you know, the copper, the physical copper is coming out of the warehouse storage and presumably is being smelted and used. So that's bullish for copper. And we have seen a pretty, you know, bullish run up in copper over the last few weeks. Although, as I said, overnight it's come off. But some of this, but again, just doing a deeper dive this morning, when copper actually had its fall, you can see here the copper price here. You can see after Trump's day on this huge dip here, on this is like this dramatic dip. There was huge buying in the futures market of forward users, basically saying, "Hey, this is a bargain opportunity. Let's load up." So that possibly explains that all of that inventory coming out of the copper warehouses, and obviously explains the this run up in price. So the question now is that sort of short-term imbalance, is that over? Has that price dip been bought? Is that going to stabilize? Because as I say, this morning we are getting a bit of a dip in copper. The other thing which I want to point out in copper here is that this is the differential here between the London prices. So you can see the London prices in white here, and you can see the high grade, which is the New York contract here, and you see the huge differential. Okay, so you see the differential here is about 9 or 10% here, and this is the differential here. So basically, traders are paying a premium for the high-grade copper, which is sold out of the New York COMEX exchange. And that's based on the idea that there's still a lingering fear or sort of expectation that Trump may introduce a tariff onto sort of imports of copper. And that caused this run up going from beginning of the year, so end of January into stuff. And this whole thing of, oh my God, Trump's going to put a sort of a premium. So a lot of physical copper was shipped into the warehouses in New York. And then we had the tariffs thing. So is that sort of a little bit of buy the dip, also potentially a premium for the trying to front run potential tariffs on imported copper into the US. We shall see. But as I say, anyway, this morning overnight, copper off a little bit. And again, for me, it's interesting just looking at the chart of copper, which I think technically, where are we? Let's go here. Just give me a second here to find it. So as you can see, this is when Trump we had this big run up just leading into Trump's big announcement on the tariffs. And you can see here, this is the high grade, so the New York copper. You see there was a huge sort of dump, basically. Traders and producers came in and bought it. And again, as I said, for me, what's interesting is that this is like a 61.8 fib retracement here, this sort of orange level here, which also is sort of a horizontal resistance. And I just wonder if that's it now. You know, the producers, they bought the cheap copper. It's now, you know, longer cheap. You know, global trade and tariffs, all that stuff we've been talking about is obviously very uncertain. So is that it, like a short-term sort of intermediate top for copper here, and maybe it just wants to retest lower? We shall see what's going on there. Okay, guys, I think that's about it for the day. I mean, what I'll just quickly say is just looking quickly at the bonds. Just to finish off here. So if we look over the European bonds, we could see not a huge amount. They're trading in a pretty tight range here. The Bund is given back a little bit, but overall we've had fairly dovish commentary in the Washington meetings from the ECB officials, and essentially saying that, you know, the immediate impact or the first impact of inflation has been sort of the tariffs has been deflationary. So the ECB seems to be willing to sort of cut more aggressively and quite quickly. And so the German bonds are quite enjoying that, especially you can see the front end of the curve here, the Schatz are quite liking that. I still think at the back end of the German curve, you know, we shall see how the economy goes, but at the end of the day, they're still doing quite a lot of issuance and infrastructure. So the 10-year Bund here and the Buxel especially just trading in a range here. It's going to be interesting to see if this wants to break out, or whether, you know, this sort of rally, which is again a 60% fib rally in the 30-year Buxel, whether that's kind of enough. We shall see. Okay, I'm just going to leave it there, guys. The only thing we have today, we have University of Michigan. Where is that? This one here, which is the second reading for April. So ordinarily the second reading is the final reading here. It's not that important, but you know, we've been getting extremely elevated inflation expectations. It was up to 6.8 last time. Sorry, 6.7 last time, expected it to be even higher, 4.4. So maybe this is going to be interesting. I mean, personally, I think the market puts a little bit too much emphasis on these very imperfect sort of surveys. And again, we know from these surveys that they're very bifurcated from a political point of view. The Democrats have one view, the Republicans have another view. in terms of where future inflation is going. So I don't know how accurate these are or whether how trustworthy or even interesting, but nonetheless, the Fed does look at them, so we need to be looking at them. What else is that? Just want to see any headlines just while we've been talking here. Not particularly. Okay, going to leave it there. Let's see how the stocks go today, whether they can have a little sort of NASDAQ rally led by Google, or whether the forward guidance of Intel ultimately will sort of depress the market. No doubt we'll be getting more tweets and headlines from our friend Mr. Trump. And that's it. Okay. I was going to mention something about the Swiss National Bank Schlegel, but he didn't say anything massively market moving. So I won't go into that. Okay. Have a great weekend. Have a great day. We'll be talking no doubt next week. Thank you.